Have you ever sold an investment property and realized a huge chunk of your profit was going straight to taxes? Capital gains tax, depreciation recapture, state taxes, it can all add up really quickly. For a lot of investors, that tax bill can easily be 20 to 30 to even sometimes 40% of the profit from the overall sale. But there's actually a strategy that real estate investors have been using for decades to legally defer those taxes and continue to grow in your portfolio. And that strategy is the 1031 exchange. So in this video, I'm going to break down exactly what a 1031 exchange is, how it works, and why it's one of the most powerful tools in real estate, and why it's the most powerful tools in real estate investors use to scale their portfolio without getting crushed by taxes. Hey, what's up guys? I'm Dorian. I'm a full-time real estate investor and agent with eXp Realty here in Connecticut. Over the past several years, I've built a portfolio of over 100 rental units, mainly multifamily and commercial property, and I've closed more than $150 million in real estate sales for clients. I've helped clients, many clients complete multiple 1031 exchanges. I've also been using this strategy within my own investing, which is one of the reasons I was able to scale to over 100 units. So I want to walk you through how this works in the most simplest way. So let's get going. At a basic level, 1031 exchange allows you to sell an investment property and reinvest the proceeds into another investment property without immediately paying capital gains on that sale. Instead of paying taxes right away, the taxes are actually deferred to the next property. It's like kicking the can down the road. The key word here is deferred. They're not forgiven. You're not eliminating your taxes forever. You're simply postponing them while continuing to grow your portfolio. Here's why it's such a big deal for investors. All right, stay with me. Let's say you own a rental property that you bought years ago for, we'll make up a number, $300,000. Over that time, the property is naturally appreciated, and now you want to sell it for $600,000 because that's what it's worth. And that sounds great on paper. But when you sell it, you're going to owe taxes on that $300,000 gain. Including federal capital gain tax, depreciation, recapture, and state taxes, that total tax bill could be easily over $100,000 depending on your situation. That means instead of reinvesting the full proceeds from the sale, you're actually reinvesting a much smaller number. This is where the 1031 exchange comes in. With the 1031 exchange, instead of taking the profit from the sale and paying taxes immediately, you're able to reinvest those proceeds directly into another investment property. And by doing that, you're deferring, not forgiven, you're deferring the taxes, and you'll keep that full investment capital working for you. So instead of losing a big portion of your profit to taxes, you can roll that entire amount into the next property. Now, it's not free, and there's a few important rules you want to follow to make sure you're staying within the IRS guidelines. First, the property you sell and the property you buy both need to be investment properties. This strategy is designed for real estate investors, not your primary residence. Second, you can't take possession of the money from the sale. The funds must be held by a qualified intermediary, which is basically a third-party company that facilitates the exchange and holds the money during the process from when you sell and when you buy. The next rule is the timeline. It's really important. Once you sell your property, you have 45 days to identify a potential replacement property. You could have multiple replacement properties. That means within 45 days, you need to submit a list of properties you may want to purchase as part of the exchange to this intermediary company. You have a total of 180 days from the sale of that original property to actually close on the new property. So again, 45 days to identify a list of potential replacement properties and 180 days to close on one of those properties. It's really important that investors look for their replacement property before they even sell the original one. And another key rule is that the new property typically needs to be equal or greater than in value than the one you sold to defer all those taxes successfully. Many investors actually use the 1031 exchange to trade up into larger properties, and I've done this many times. Thinking about relocating to West Hartford, Connecticut? Well, I've got just the thing for you. My team and I have actually taken the time to create the ultimate relocation guide, which is ultimately meant to save you hours of research, and I've linked it down below. From top employers to the best hospitals and a boatload of other things that you're going to need to know before making the move. The best part is this guide is 100% free. That's right, you heard me, 100% free. Just click the link in the description or the top pinned comment. Hope that helps. For example, someone might start with a small rental like I did and then exchange into a larger multifamily property and then keep exchanging, kicking the can down the road into bigger and bigger assets. There's also something called a boot. A boot is where you 1031 some of the funds, but you also receive some of the funds in your account. Now, you'll pay taxes on the funds you received, so you don't always have to 1031 the full amount. Let me give you a quick example and how you can see how this works in practice, right? I actually recently helped a client sell his 3-family in New Jersey, and he bought a 6-unit here in Connecticut. He sold the 3-family, I think it was for $570,000, and he bought a 6-unit here for $725,000. So he came to CT, toured a bunch of properties, and while he was getting ready to list that 3-family, he identified 4 possible replacement properties, including the 6-unit he ended up buying. Once he sold that 3-family in New Jersey, all of those proceeds, except for $50,000, were held in escrow by an intermediary. He actually wanted $50,000 for rehab funds and etc. So he did get taxed on that $50,000, but he was able to defer the bulk of that gain. So in a nutshell, he was successfully able to sell the 3-family, and instead of touching all the proceeds, the money stayed in escrow with the intermediary company. Now, let's say an investor owns a 3-family property. They bought it years ago for $300,000. Over the time, the property is appreciated and they decide to sell it for $600,000. If they sold that property and paid taxes, they may lose well over $100,000 to capital gains. Here's where things get a little bit more interesting from a long-term tax standpoint. And I'm not an accountant, so be sure to check with your local accountant. But many experienced investors don't stop doing one 1031 or don't do one 1031 exchange and then stop. A lot of investors will complete multiple exchanges like myself their lifetime, continually trading up into larger properties. You might go from a 3-family to a 6-unit, and then you might even go to a 20-unit and maybe eventually to a 50 or 100-unit apartment building. And because each exchange defers taxes from the previous sale, those capital gains can continue getting pushed further and further down the road. Now, they're still not forgiven. If you ever sold that property, you would owe taxes on all of those properties. So you could see how a little tax planning might go a long way. Now, when you combine the 1031 exchange with another powerful concept in real estate called the step-up basis, you can accomplish this. When someone passes away and real estate is inherited by their beneficiaries, the tax basis of the property can reset to the current market value at the time of inheritance. So what does that mean? That means all of the capital gains that have accumulated over the years can essentially disappear from a tax standpoint. So imagine an investor who bought a property decades ago for $300,000. For the appreciation and improvements, that property is now worth $2 million. If they sold the property during their lifetime, they would owe taxes on that gain. But if that property was passed down to their children through proper estate planning, often through trusts or other structures, that tax basis can reset to that new market value. So then if the heir decides to sell the property because he doesn't want to be in real estate, there would be little to no capital gain owed on that property. This is why you'll sometimes hear long-term investors say defer, 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 defer. They may continue doing 1031 exchanges throughout their lifetime, continue growing their portfolio, and ultimately pass down those properties to the next generation tax-free. When you combine strategies like 1031 exchanges and long-term ownership, depreciation, and estate planning, you can start to see why real estate has been one of the more powerful wealth-building tools for generations. Of course, every investor's tax situation is different, so these strategies should always be discussed with a qualified tax professional or estate planning attorney, but understanding how these tools work completely change how investors think about building wealth through real estate. And as always, if you guys found this video helpful, make sure to hit that like button and subscribe. And if you have any questions about real estate investing, 1031 exchanges, or building a rental portfolio, please feel free to reach out. I'm always here to help. Thank you for watching, and we'll see you in the next video.